In this lecture, we will go over the CFA Level 1 reading on demand and supply analysis, the firm. This reading has three sections. We have a brief section which talks about the objectives of the firm, and most of this reading is based on section 3, analysis of revenue, costs and profits. Let's start with the objectives of the firm. We study in finance that the objective of the firm should be to maximize shareholder value. In this reading, however, we assume that the objective of the firm is to maximize profit over the period ahead, and we assume that prices and quantities are known with certainty. This might seem simplistic, but it forms the basis or the foundation for what we really need to do, which is given right here. Notice that when we talk about maximizing shareholder value, then we need to take a multi-period perspective. There is also uncertainty and risk. So we need to consider several variables when we try to maximize the value of the firm. And as I said, this particular reading takes a simplistic assumption, but it is important to be able to do this right before we can go on to the larger task of figuring out how to maximize shareholder value. In other words, in this reading, we need to determine what are the quantities at which a firm is going to maximize profits. The question then becomes, what is the definition of profit? And the answer is that it depends on who you ask. If you ask an accountant, he will give you one definition. If you ask an economist, he might give you another definition. So let us talk about the various definitions that you need to know as part of this reading. We'll start with accounting profit. This is the profit or net income on a company's financial statements. The financial statements will be created based on some accounting standard. So in most parts of the world, accounting statements or financial statements will be created based on IFRS. In the United States, the income statement will be created based on US GAAP. These are accounting standards which define how we come up with the revenue number. They define how we come up with different cost numbers and so on. The basic formula though is accounting profit is equal to total revenue minus total accounting costs. Then we come to the definition that is going to be important in this reading, which is economic profit. This is also known as abnormal profit or supernormal profit. Economic profit is the accounting profit that we calculate over here minus any implicit opportunity costs. The point is that with accounting profit, we only consider explicit costs which IFRS or US GAAP allow us to subtract. We generally do not subtract any opportunity costs or implicit costs over here. But when we talk about economic profit, we also need to subtract these implicit costs or opportunity costs. Another way of expressing economic profit is to say that it is total revenue minus total economic costs. So you can think of total economic costs as being equal to the accounting costs or the explicit costs plus the opportunity costs. You also need to know this definition, the definition of normal profit. Normal profit is the accounting profit a firm must earn in order to cover implicit opportunity costs which are ignored in the accounting costs. Let us understand these concepts through a couple of examples. We'll first take a startup company, and let's say that you are running this company. You generate an accounting profit of 300,000. This is based on your total revenue minus explicit accounting costs. It turns out that to run your own company, you are taking a salary cut. Your salary, if you were to work at a regular large company, is, let's say, 300,000 or would be 300,000, but you are paying yourself 200,000. This means that you are taking a salary cut of 100,000. This is an opportunity cost. So we take the 100,000 into account. You also invested 1.5 million of your own, and you could have invested this money elsewhere and received a return of 200,000. So this 200,000 is not an explicit cost, but it is an opportunity cost. You have foregone the opportunity to earn 200,000. Our opportunity cost, or the implicit cost, is 300,000. If we now calculate our economic profit, it is zero, because once we subtract these opportunity costs, we get an economic profit of zero. We can also say that we are earning a normal profit. So a normal profit of 300,000 is enough to cover our implicit costs. Here the accounting profit just covers the implicit opportunity costs. Another example, and this is an example of a publicly traded company. With publicly traded companies, the cost of equity is generally considered the implicit cost. Here we assume that the executives and the team that works at this company is paid based on market rates, and whatever facilities are being used are being paid for at the fair rate. So the implicit cost, or the opportunity cost, is the return that could be received on the equity that has been invested in this company. Let's say the equity investment is 18.75 million and investors require a return of 8%. These concepts will be clear once you study corporate finance and equity. So you can calculate the opportunity cost by doing 8% of 18.75 million, which is 1.5 million. Now let's say that this company generates an accounting profit of 2 million. The economic profit is 0.5 million, because if we take the 2 million accounting profit, subtract the opportunity cost, we will get an economic profit of 0.5 million. The normal profit, which is the profit needed to cover the opportunity cost, is 1.5 million. So notice that numerically the normal profit is equal to the opportunity cost. Here is another related concept, that of economic rent. Economic rent refers to payment to a factor of production in excess of opportunity cost. Opportunity cost, as we've discussed before, is the cost of the next best opportunity. In this case, if we are using a particular factor, what is the cost of the factor in its next best use? Economic rent results when a particular resource or good is fixed in supply, so roughly a vertical supply curve as shown over here, and the market price is higher than what is required to bring the resource or good onto the market and sustain its use. Let us take an example which is given in the curriculum, and this is the example for gold. We have a reasonably vertical supply curve. So we are shown numbers for 2006 and 2008. In 2006 the supply was this much. In 2008 the supply is roughly the same. There is a slight decrease in supply. So simplistically we can say that we have a vertical supply curve. But what about demand? Notice that when we have a vertical supply curve, then the price is determined by the demand curve. Earlier we had demand curve D1, so we had a certain price. Let's say that initially the price was about 603, and then there is an increase in demand. When there is an increase in demand, obviously the price goes up. So here we have the price going up roughly to 659. The increase in price here is about 44%. If we now look at the total additional payment for gold, it is equal to this quantity multiplied by this change in price. So effectively, the area shown by this rectangle is called economic rent. From an exam perspective, I think this slide is important where we compare different profit measures. Specifically, we look here at the relationship between accounting profit and normal profit. If our accounting profit is higher than normal profit, let's say that normal profit is 300 and accounting profit is 400. This is a good thing because here we have positive economic profit. Remember, economic profit can also be written as accounting profit minus normal profit. In this simplistic scenario, the economic profit is 100, it is greater than 0. The firm is able to protect economic profit over the long run. So if this is indeed happening, that will have a positive effect on the market value of the firm's equity. Another scenario is where the accounting profit is equal to the normal profit. Here the economic profit is 0 and no value is being added. And the final scenario is where the accounting profit is less than the normal profit. Here we have a negative economic profit. That means that economically speaking, we are suffering losses, and that will have a negative impact on the firm's market value. Analysis of revenue, costs and profits. This is the major section in the reading. Some general pointers. We will see that revenues and costs are calculated in terms of total, average and marginal terms. We talked earlier about accounting profit and economic profit. We also talked about accounting costs and economic costs. Here in this section, when we talk about costs, we are referring to economic costs. And finally, when we talk about costs, we will consider both total and variable costs. Here is a laundry list of terms that we are going to see in this section. And rather than talk about each one of these individually, I will give you a way of remembering these terms, and I hope this will make it easy for you. This is something that I'm sure every CFA candidate knows and understands, that profit is equal to revenue or total revenue minus total economic costs. Now, total revenue and total cost is fairly intuitive. Just like we have total revenue, we can divide total revenue by quantity and come up with what's called average revenue. Similarly, we also have an average cost, which will be total cost divided by the total items that are produced and sold. And then we have marginal revenue. Marginal revenue is the revenue from one additional unit sold. It is also sometimes calculated as the change in total revenue minus change in quantity. Similarly, we have a marginal cost term, which is the cost of producing one additional unit. This is also at times written as change in the total cost divided by change in quantity. Now, with cost, we have two components. So the total cost can be thought of as total fixed cost plus total variable cost. And again, let us go down the average and marginal track. Total fixed cost is obvious. What about average fixed cost? This would simply be the total fixed cost divided by the quantity that is produced. So that is straightforward. Similarly, we can have an average variable cost, which would be the total variable cost divided by quantity. What about marginal fixed cost? What is the fixed cost for one additional unit produced? That doesn't really make any sense because the fixed cost by definition is fixed. So there is no concept of a marginal fixed cost. So this is not applicable. What about marginal variable cost? That is the cost of producing one additional unit. And there isn't really any difference between saying marginal total cost or marginal variable cost. They are effectively the same thing. That's why the term that we use is simply marginal cost. So that covers all the terms that you see over here. I hope you can remember it by saying that there is revenue and cost, and then the other dimension is to recognize that we have total, average, and marginal, and the final thing is with cost we have a fixed cost component and a variable cost component. Now let's get into the concept of profit maximization. Profit maximization is a good thing. The curriculum makes several points which are fairly intuitive, but the point that I think is most testable is that profit maximization promotes what's called allocational efficiency. Allocational efficiency is where resources flow to highest value uses. If companies are not profitable, then ultimately they go out of business, and obviously that is not good for the economy, it's not good for people. That I'm sure you know anyway. In this particular section, there are several subsections. We'll talk first about total, average, and marginal revenue. Then we will switch to the cost side, and on the cost side we'll start by understanding the various factors of production. We will then look at total cost, average cost, marginal cost, and then fixed and variable costs. Then we'll talk about output optimization and maximization of profit. The idea here will be what quantity to produce in order to maximize profits. Then we will talk about economies of scale and diseconomies of scale. And finally, we will cover profit maximization in the short run and long run. On this slide, we will look at total, average, and marginal revenue in a perfectly competitive market. Let's say that you sell widgets and each widget is sold for 100. If you sell one widget, the price is 100. The total revenue obviously is 100. The average revenue is total revenue divided by 1. That's 100. And the marginal revenue, which is the additional revenue for selling one more widget, is 100. When you sell two widgets, all the numbers are the same except total revenue, which is now 200, 100 into 2. If you sell three widgets, the price would still be 100, total revenue would be 300, the average revenue would be 300 over 3, which again is 100, and the marginal revenue is 100. If we are to draw the total revenue curve and the marginal revenue or demand curve, total revenue looks like this, and this is the price, which is the same as marginal revenue, which is same as demand. On the left we have quantity on the x-axis, we have revenue on the y-axis, and there is a linear relationship between revenue and quantity. As quantity increases, revenue increases linearly. So quantity 1, revenue 100, quantity 2, revenue 200, and so on. A fairly straightforward relationship. And as I have mentioned, here on the right, quantity is the x-axis and we have a dollar figure on the y-axis. Notice that no matter what the quantity, the price is 100. This is a characteristic of a purely competitive or a perfectly competitive market, and we'll discuss this in more detail in the next reading. But price is 100, marginal revenue in a perfectly competitive market is going to be the same as the price, and this also represents our demand curve. Now, what will happen if the price for some reason goes up to 150? Before you move on, or before you look at the answer, I want you to draw what happens to the total revenue curve and the price slash marginal revenue slash demand curve. Here is what you should come up with. The total revenue curve now looks like this. If quantity is 1, we are at 150. If quantity is 2, we are at 300, and so on. And the price or marginal revenue curve goes up from 100 to 150. Now we look at the revenue curves if there is imperfect competition. In this scenario, here is what's going on. Again, let's say you sell widgets. Now you are selling widgets where the amount you sell and the price are related. So if you sell 1, in other words, let's say you have set a price of 20, then the quantity demanded is only 1. If you reduce the price of widgets to 18, then the quantity demanded is 2. If you reduce the price even further to 16, then the quantity demanded is 3. So we have a classic downward sloping demand curve. Now, total revenue should be straightforward. Total revenue is quantity times price. The first one is obvious. What about 48? Where is this coming from? Here, when you set the price at 16, then the quantity that you sell is 3. The total revenue is 3 times 16, which is 48. Average revenue will be total revenue divided by quantity. So 48 over 3 is 16. Notice that average revenue and price here would be the same. What about marginal revenue? Marginal revenue is the revenue from selling 1 additional unit. When you sell the first unit, the additional revenue is 20. When you sell the second unit, the marginal revenue is 16, because total revenue then goes from 20 to 36. This change is 16. That's where the marginal revenue of 16 is coming from. So where is 12 coming from? This 12 is coming from 48 minus 36. When you sell the third unit, the incremental revenue from 36 to 48 is 12. So that is your marginal revenue. If you follow this table, notice that as the quantity is going up, the price is coming down. So in this region where we go from 5 to 6, the price is coming down, quantity is going up, but total revenue is staying the same. And that is happening over here. So as we go from a quantity of 5 to 6, and here again, x-axis is quantity and the y-axis is a dollar figure. As we go from 5 to 6, the total revenue is flat at 60. And notice that when this happens, the marginal revenue is 0, because as we are going from 5 to 6, the additional revenue is 0, or the marginal revenue is 0. That's why the marginal revenue curve is at 0. In other words, it intersects the x-axis where total revenue is at a maximum. At this point, the total revenue is not changing. After this point, what's happening? So as we increase the quantity above 6, the total revenue is coming down because the decrease in price over here in percentage terms is more than the increase in quantity, again in percentage terms. So hopefully these pictures make sense. For now, just remember that when we have imperfect competition, we'll have a downward sloping demand curve. That demand curve represents the price at different quantities. It also represents the average revenue at a given quantity. The marginal revenue curve will be inside the demand curve and it will be steeper, and the marginal revenue curve will intersect the x-axis. In other words, marginal revenue will be 0 when total revenue is over here. So these numbers also can be plotted out over here, and this should make complete sense. Now I want you to do example 2, which is similar to what we are seeing here. It's only that the numbers are a little bit more complicated. Coming now to factors of production, and understanding factors of production is important before we get into the specific costs. Factors of production are the resources a firm uses to generate output. A firm or a business obviously has to be on some piece of land, so that land is one of the factors of production. Labor, all the people who are working for a business or a firm would be considered labor. This would include skilled labor, unskilled labor, and all layers of management. So the people here working for a given firm would be labor. Capital. Capital has many meanings. In this context, we refer to physical capital. So the building, the equipment, the machines, the tools, etc., which are used by a business would be capital. And then materials generally refers to raw materials. So when a business produces output, obviously it needs some input, some raw material. That is what we refer to as materials. A production function shows the relationship between output. The output is also sometimes called the total product, and the factors of production. Here are the various factors of production. In this particular reading and in many economics textbooks, we take labor as the factor that is most easy to change or vary. So let's do that over here. We are looking at total product as a function of quantity of labor. Marginal product would be the additional output that is produced by using one more unit of labor. Now, if we start with 0 labor and then we add 1 unit of labor, our output will go up by a certain amount. Then we might add another unit and our output will go up, and so on. So let's say that we go to a certain level and our output keeps increasing. The increase that we have for every unit is called the marginal product. Let me draw a situation here where the marginal product is improving as we add more labor, but then after a certain point, then we get to diminishing returns. So after this point, there is an increase in output, but at a decreasing rate. What I mean by that is, up to this point, adding more labor increases output, and it increases output at an increasing rate. Notice that this curve is going up, the slope is increasing. But then after this point, the output is going up, but at a lower rate. Here we are at diminishing marginal returns. So there are returns, output is up, but at a diminishing or lower rate. Then we reach a certain peak, and after that adding more labor actually produces less output. So here we have achieved, or here we are majorly inefficient. These are simple concepts that are discussed in more detail later, but what I want you to do at this stage is cover example 3 in the curriculum. On this slide, we will look at total, average, marginal, fixed and variable costs. On the left, we have total fixed cost, total variable cost and total cost. Total fixed cost by definition is flat. If we have quantity of output on the x-axis and cost on the y-axis, total fixed cost is the same no matter what the quantity of output. And keep in mind that all the graphs and pictures that we are looking at here are from a short run perspective. The costs and the graphs will be different if we take a long-term perspective, and we'll talk about that in more detail later. So this is our total fixed cost. Total variable cost obviously increases as the quantity of output goes up. Here I have shown a simple linear relationship. With this simple linear relationship, what we are going to have is a total cost, which is simply the total variable cost plus the fixed cost. If we had a non-linear relationship, then we might have a situation like this. This might be your total variable cost. Even here, the total fixed cost would be a vertical displacement. So at every point, we would add the fixed cost and come up with the total cost. But the linear graphs explain this or show this quite well. Now let's come to the right side of the screen, and here again I'll emphasize that we are looking at short run costs or short run curves. In the long run, the costs will be different, and therefore the long run curves are going to be different. Let's consider the average fixed cost first, which is easy to understand. Average fixed cost is simply the total fixed cost divided by quantity. When the quantity is small, over here the average fixed cost will be relatively high. As quantity increases, the average fixed cost, which is total fixed cost divided by quantity, obviously comes down. So that explains why this is bending downwards. Obviously, when the quantity is very high, and if we are going from say 1000 units to 1001 units, then average fixed cost still comes down, but by a very small amount. That's why the slope over here is very small. Next, let's look at the average variable cost. This is an example. The average variable cost function or curve will vary from company to company or industry to industry. Here we simply have a U-shaped curve, which is implying that initially the average variable cost comes down, it hits a certain minimum, and then it increases. And we are making the same assumption with the average total cost, where the average total cost comes down, it hits a minimum, and then goes up. Because of the fixed cost element, the average total cost obviously is higher than the average variable cost. The distance between these two is going to be the average fixed cost. Since over here the average fixed cost is less compared to where we have a smaller quantity, the difference between average total cost and average variable cost is small over here, and the difference is large on the left hand side of this particular image. Finally, we look at marginal cost, which is the additional cost of producing one more unit of output. The marginal cost curve intersects the average variable cost at the minimum. This is the minimum of the average variable cost. The marginal cost curve also intersects the average total cost curve at this minimum point. Again, this is the minimum of the average total cost. From an exam perspective, you need to know this. I'm also going to give you an explanation, which if you understand, that's good, but if you don't understand, it's not such a big deal. Let's say that we are at this point over here. Let's say that the quantity here is 10. Let's say that this minimum point is 12, just picking some numbers to make this analysis or make this explanation easier. When we produce the 10th unit, let's say that the marginal cost, or what we are seeing here is that the marginal cost, let's say, is 5 versus at this point an average cost of 7. If the marginal cost of producing one more unit is less than the average cost, then producing that one more unit is actually going to pull the average down. On the other hand, if you are, let's say, at this point where the marginal cost is more than average, then producing that additional unit will pull up the average. Since being on the right or producing one more unit to the right of this minimum pulls the average up, and being to the left pulls the average down, that's why it must be that the marginal cost intersects the average variable cost at the point where the average variable cost is the minimum. If you understood that, great. If not, just remember the fact that the marginal cost curve intersects the average variable cost at the minimum. And the same explanation applies over here. The marginal cost curve intersects the average total cost curve at the minimum point. Here is a simple example where we go over the calculation and then the interpretation of the various costs. The interpretation actually has been covered on the previous slide, and if you understand the calculation, the interpretation is fairly straightforward. Let's say we are producing widgets again. At a quantity of 0, we have a fixed cost of 500. When you produce the first widget, the fixed cost still is 500, but now we have a total variable cost of 200. The average fixed cost is 500. This is 500 divided by 1. Average variable cost is 200. This is 200 over 1. The total cost is the sum of the fixed cost and variable cost. The average total cost is the total cost divided by quantity, and marginal cost is the cost of producing one more unit. When you produce the second unit, the fixed cost by definition is the same. The total variable cost is 380. This is the variable cost associated with producing 2 units. The average fixed cost now is 500 over 2, which is 250. The average variable cost is 380 divided by 2. The total cost is equal to 500 plus 380. Average total cost is the total cost of 880 divided by 2, and the marginal cost is the additional cost of producing one more unit. There are two ways of arriving at 180. You can look at the change in total cost, 700 to 880, or you can look at the change in variable cost, which is 200 to 380. Notice that in both cases you will get 180. That's why we just have this term, marginal cost. We don't say marginal variable cost or marginal total cost. We just say marginal cost. If you've understood these two rows, then you are in good shape. You can now look at example 4, which covers the same concept but just has a lot more numbers. On this slide, we will understand the short-run supply curve, the break-even point and shutdown point under perfect competition. Here is an excerpt from the previous slide. We have a dollar figure on the y-axis, quantity on the x-axis. We are looking at the marginal cost curve for a given product, the average total cost and the average variable cost. Let's say that we are initially at this point. Say the price here is 150, and let's say that's P3. Given that we have perfect competition, the price is the same as the marginal revenue. This is the additional revenue from selling one more unit. That is also the same as the average revenue, and this also is the demand curve. This happens when we have perfect competition. In this situation, the firm will be happy. Why? Because the quantity that it produces is based on the marginal cost curve. It's the intersection of marginal cost and the marginal revenue curve, and we'll understand why in a little while. But for now, just take my word for the fact that this is the profit maximizing quantity. The firm is making money. Why? Because the marginal revenue and also the average revenue is more than the average total cost. So there is a economic profit. If the price comes down to say this level, the firm is still happy because the average revenue is still greater than the average total cost, so money is being made. At this point, the firm breaks even. Why? Because here at a price of P2, let's say this is 100, the average total cost of 100 is equal to the average revenue, also 100, and therefore the profit is 0. This point then is called the break-even point, and the break-even quantity can be read off the quantity axis or the x-axis. What if the price falls below 100? Say the price comes down to 90. Then we are at this point over here. The firm, at least in the short run, will continue to operate because the money that is being made over here. So on average, the revenue is 90. This 90 is still more than the average variable cost for this particular quantity. Since the revenue or the money made per item is more than the variable cost, in the short run, the firm will continue to operate. If the price keeps falling and we come to this point, this is called the shutdown point, because if the price falls below this point, say the price comes down to 70, and let's say that this shutdown point is 75. The price comes to 70, the company is receiving an average revenue of 70 and the average variable cost is 75. It clearly does not make sense for the firm to operate. Therefore, this point is the shutdown point. Now, what is the short run supply curve? Notice that as long as the price is above 75, the firm will produce at least in the short run. So this part that I am shading dark red, this part is the short run supply curve. This is the shutdown point, that is the break-even point. Now what I want you to do is look at example 5 and example 6 in the curriculum. I hope that what you are looking at over here also makes sense. In the short run, if the price is greater than average total cost, so that means that we are in this region, the obvious decision is to operate. We've talked about the fact if price is equal to average total cost, so that's this point, then that's the break-even point. If average variable cost is less than price, is less than average total cost, that is this region over here, then at least in the short run, the firm will operate. And if the price is less than average variable cost, then the short run decision will be to shut down. What about in the long run? In the long run, if we are in this region 1, let's say this is region 1, obviously it makes sense to operate. If price is equal to average total cost, as discussed, that's the break-even point. This region, it's okay to operate in the short run, but it doesn't make sense to be here in the long run. So if we are in this region, then the long run decision will be to shut down. And obviously in this region, we shut down in the long run and the short run.